We are here to discuss PNB Housing Finance Q1 FY2024 results. You must have seen our business and financial numbers in the presentation and press release shared with the Indian stock exchanges and is also available on our website. With me, we have our entire management team across verticals sitting over here, led by Mr. Girish Kousgi, Managing Director and CEO. We'll begin this call with the performance update by the Managing Director and CEO, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual developments and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 28 of the investor presentation. With that, I will now hand over the call to Mr. Girish Kousgi.
Good afternoon and welcome to all the investors to Q1 earnings call. First of all, thank you very much. We completed a rights issue in Q1 to the extent of 2,494 crores, and thank you so much for long-standing support to the company. Issue was subscribed 1.21 times. All the four top shareholders, namely PNB, Carlyle, Ares SSG, and General Atlantic, they participated in the rights issue, and this apart, I think a lot of institutional investors, they participated. Proceeds of the rights issue are being utilized for disbursements. Q1 was very, very eventful for us, and as a company, we've done well on most of the parameters. On disbursements on a YOY, we've shown a growth of 8%. Market is quite robust. There was a bit of cyclical aspect in Q1. But yes, we have been trying to do a lot of things to de-risk the book what we're going to build in future. For example, our focus was more on salaried. Our focus was more on home. Our focus was also more on low ticket, size in terms of our incremental disbursements. On a quarter-on-quarter compared to Q4, there was a drop in disbursement. This is in line with market trend in the industry, and we saw a lot of traction in affordable space. We were able to grow our disbursement by 66%. In Q1, we did 228 crores, and the previous quarter was 137 crores. We see a lot of traction, and that was really, really good for us. And if you have to look at the login numbers, just to give you a data point, login numbers on a YOY grew by 11% and sanction value by 15%. On the loan book, on the retail side, we were able to grow by 11%, and this happens to be the highest ever book growth in last 15 quarters. Overall loan book grew by 5% on a YOY basis, and retail book 11%. Sequentially, loan book grew by 2% and retail loan book grew by 3%. We are on track in terms of our guidance for book growth, which is about 17 to 18%, and disbursement growth of 22+% for the year. In spite of our conscious strategy in terms of degrowing corporate book, the loan book crossed 60,000 crores. So as of 30th June, the book was 60,395 crores, and this again is highest in last 7 quarters. In terms of customer retention, I think there has been a significant improvement on a YOY basis. Last year, Q1, the book runoff was 23%. Am I audible? I think there's some disturbance. Yeah. So last year, Q1, the book runoff was 23%, which is down to 16.58% this quarter. The book runoff has reduced by over 600 bps YOY. In terms of asset quality, there has been a lot of traction. We are pretty aggressive on SARFAESI and legal action. There is significant focus on cash collections and settlements. We have a good pool of retail loans, which is ready for auction. So remainder of the year, we should see good traction in terms of NPA reduction. So typically, when you see quarter one will be muted, A, in terms of growth, B, in terms of asset quality improvement. Generally, there is slight increase. I think given our book and the challenges what I had discussed in the past, we were able to still bring down GNPA on the retail book. I think the traction is pretty good. I think in next few quarters, we will see this number coming down quarter after quarter. With respect to corporate GNPA, we have 2 accounts. There has been no addition at all. Only thing is because of Indes, the percentage looks higher, and also the book degrew compared to March. So if you have to talk about credit cost for the quarter, it is 0.36%. I think credit cost largely, we had said in the past that we will build up ECL. We will increase the PCR, I think to a large extent of 0.36%. It was only to true up ECL, especially on the retail and to a certain extent on corporate. Otherwise, credit cost has been very, very less for the quarter. So I was talking to you about our focus on getting the profile mix right. I think we are on line in terms of what we had stated earlier. So our salary is increasing. If you have to look at year on year, there has been consistent increase in salary, and the self-employed share is going down. This is true even incrementally as well. Just to give you some data point, if you have to look at less than 1 crore, it was 4.3% last year quarter one, and if you have to see that number now, it has increased to about.
Sorry to interrupt you.
Sure. So if you have to look at
So you're connected to the call. Please go ahead.
Okay. If you have to look at less than 1 crore, it was 81% last year quarter one, and this year quarter one, this number has increased to 85.3, which means our focus is A, on retail, B, in terms of up to 1 CR. So our focus is up to 1 CR, even though we have a cutoff at 3 CR. We rarely do any case beyond 3. Our focus is up to 1 CR. So we are seeing that there's a lot of concentration of the loans what we do up to 1 CR. Now this is good for the portfolio in the long run. This same trend is seen even incrementally as well. When we saw this data a couple of quarters back in terms of geographical mix, we were quite low in South. So we consciously tried to increase our business from South. If you have to look at, let's say, quarter 4 of last year, it was 32.5, and quarter 1 of this year, which is just after a quarter, we are close to about 36% in South. So the mix in quarter 4 on disbursement was North was 34.3, West was 33.2, and South was 32.5. Quarter 1, North is 35.3, West is 29, and South is 35.8. So we are slowly trying to increase our business from South, which was pretty low, given the mix what works for this industry. And same trend is seen incrementally as well. Total branches expanded to 198 as on 30th of June, which was 189 as on 31st of March 23. Affordable branches expanded to 88 as on 30th of June, primarily in Tier 2 and Tier 3 cities. On the affordable, we would reach 100 branches in a quarter or two. Currently, we are at 88, and we will reach about 100 branches in a quarter or two. On the corporate book, we had 2 NPAs last quarter. This year as well, this quarter as well, it is 2 NPAs. Total amount is 854 crores. Out of this, one account constitutes to 92%, which is backed by a large developer. The increase in corporate percentage is because of index effect. There has been nil stage 2 in corporate. This was, I think, the last few quarters there has been 0 accounts in stage 2. On a YOY basis, the corporate book has degrown by about 45%, and sequentially the book has gone down by 10%. Little bit on the financials. On revenue, on a YOY basis, we've shown a growth of 21%. Net interest income, there is growth of 70%. PPOP is 41%. And PAT, there is a growth of 48% from 235 crores to 347 crores. Yield has improved even sequentially from 10.41 to 10.59. Cost, there was a marginal increase in cost. So last quarter the cost of borrowing was 7.76 and now with the 7.97. So now the cost on portfolio and incremental both are around 8%. Spread, we were able to, spread is flat. We are at 2.62%. Last quarter was 2.65. NIM slightly improved from 3.74 to 3.86%. Gross margin improved from 3.83% to 3.91%. Credit cost as guided for the year is 0.6%. Quarter 1 was 0.3. As I mentioned, 0.36 was largely, this was due to true up in ECL, both in retail as well as corporate, since we wanted to increase our PCR. ROA, which was 1.71 last quarter, for the whole year 1.61%, now is 2.07%. ROE has improved to 11.18. Capital adequacy, now we are at almost 30%, and the leverage is 3.82. Couple of points on the outlook. I think demand is quite robust. We are seeing a lot of traction across markets. So we see a lot of demand on the prime side and more so on the affordable side. Even I am privy to some of the reports which talked about affordable demand going down, but we have not witnessed that, even though the base is very small. We started a few months back, but we are seeing very good traction on the affordable piece. So there will be a lot of traction in the coming quarters on the affordable side. ROA of 2.07%, this is the highest in almost a decade for the company. And in terms of guidance, I think we had mentioned the spread of 2.5, NIM of 3.5, and credit cost for this year it will be 0.6, and from next year onwards it will be 0.4. We are happy to inform that CARE rating has revised the rating outlook to positive from stable. The credit rating of the company from CARE is now AA with positive outlook. And we are engaging with other rating agencies for possible outlook change or an upgradation. I would, yeah.
Yeah, man, we can go ahead and take go for the Q&A.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1 at this time. The first question is from the line of Ashwini Agarwal from Demeter Advisors LLP. Please go ahead.
Good afternoon, team. Congratulations. Very solid.
Ashwini, your line is not very audible. Please use the handset.
Is this better now?
Yes.
Yeah. Good afternoon, team. Congratulations on a very good set of numbers. Two questions.
Ashwini, sorry, the line is still echoing a little bit. Can you please use the handset mode? It's still echoing.
Okay. Let me come back. Why don't you proceed with the queue and poll me once again?
Sure.
Thank you.
Thank you. The next question is from the line of Renish from ICICI. Please go ahead.
Yeah, hi. Hi, team. Congrats on a good set of numbers. So just one question on the margin side. Okay, so now considering that we have raised capital to the tune of 25 billion in May, so of course there will be a positive impact on the borrowing side in coming quarters. Given this quarter there is an impact of only 1 month, and given the portfolio mix, is going to shift towards affordable and prime, which is a higher yielding book. So what is the reason we are still guiding for a lower NIM in coming quarters when you say that, full year NIM will be at 3.5 versus more than 3.8 now?
No. Actually, in terms of guidance, spread and NIM, this is the threshold. So we'll be able to sustain what NIM you're seeing now, which is about 3.75 or so. But I think the guidance on a long-term steady state is going to be 3.5. That is the threshold, what I mentioned.
Okay. And so maybe next couple of quarters, there is a fair amount of chance that NIM could sustain it around this level, considering the fundraising and the book mix change.
Yeah.
Okay. That's it from my side. Thank you.
Thank you. The next question is from the line of Ashwini Agarwal from Demeter Advisors LLP. Please go ahead.
Hi, is this better now?
Yes, much better. Please go ahead.
Yeah, thank you. Congratulations to the team for pretty good numbers. So 2-3 questions. One is, how do you feel about the retail GNPL numbers considering the kind of mix you're pursuing? Do you think in a couple of years we should be looking at industry level NPLs, which are GNPL ratios somewhere in the handle of 1.2 to 1.4, and credit costs in the ratio of 20 to 30 basis points? I know you have 40 basis points guidance for fiscal 25, but how do you feel about this?
GNP, I think 2 years is too long a time. So we are looking at being comparable with best in the industry in next 4 to 5 quarters. The numbers what you mentioned, in terms of credit cost, I think I would want to stick to 0.4 because this will be a mix of both prime and affordable. So typically, if you look at credit costs for a company which is focusing only on, let us say, super prime and prime, credit cost will be around 0.2. Could be 2 or 3 bits more or less. But if it is a combination of prime and affordable, and with every passing quarter, the mix of affordable will keep increasing because that is where we see a lot of value, of course, coupled with prime as a segment. And therefore, we would like to guide a credit cost of around 0.4. So we can take a call maybe after 3 or 4 quarters. At this point in time, we feel that 0.4, given the mix of prime and affordable, which will emerge over a period of time, I think that is what we feel is comfortable.
Okay. And so over the next 2 years, what kind of gearing do you think is achievable? I know you have an eye on credit rating as well, but, unless the gearing goes to at least 5x or 6x, the ROE handle will not go to mid-teens. At least that's what I think. But how do you feel about gearing and the ROE versus the credit rating balance?
So we are at 3.83 now. So we will be comfortable between 6 to 6.5 times. So that's the plan, and we also have ambition to grow book to a level of 1 lakh crore.
And which should therefore translate into an ROE, say 2.5, 3 years out in the handle of 16-17%. Would that be fair?
Yeah, I mean, it will take 3 to 4 years to reach to a level of 5 plus, and then it should further increase from those levels.
Okay. And do you plan to return to paying dividends at some point?
We will take an appropriate call at the appropriate time, but yes, the idea is to grow a profitable book, keeping in mind all the return ratios. As far as dividend is concerned, I think we will take an appropriate call in consultation with all the stakeholders.
And so the last question is the large corporate loan account. Do you have any sense on when it will get resolved, either by way of a sale or a settlement or something?
See, as we speak, we are working on all the corporate accounts. Today, if you see, the book has come down to almost about little over 3,000 crores, right? So we really don't see stress in the existing book. And if you look at our book for last few quarters, we don't have anything in stage 2, and we have just 2 accounts in NPA. Out of 2 accounts, 1 account constitutes to about 92%. And we have been constantly working on resolution, and we have done some resolution in the last few quarters. So naturally, if you see, I think the book should run down maybe in next 3 years and all. But we are trying to accelerate, the repayment. It could be possible resolution in terms of settlement. So we are looking at various options. So I think the book could definitely run out, but not the time frame is not over 3 years in any which way.
Okay, no, my question was more relating to this one large NPL, the 800 odd crore number. I mean, is there any visibility on that getting resolved?
We are working on resolutions, and it is through multiple channels. So I would not be able to divulge more details on that, but I can only say that we are pretty comfortable.
Okay, perfect. Thank you, sir. All the best.
Thank you.
Thank you. The next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you very much for the opportunity to me. Sir, your investor presentation, page number 10, you have shown 2,762 crore reduced from corporate loan book. Will you tell how much we have received and how much we have write-off?
So if you can see in the same table, we have also given below that what all has been through our sell-down, natural runoff as well as write-off. So if you can see from March till June, which is 5 quarters, we have a natural runoff around 1,100 crores, 1,400 crores of sell-down, and 1,500 crores of approximate as the write-off.
No, can you give the bifurcation of 2,762 systematically? 1,140, 1,400 and 1,500. How I can reconcile this?
So, look,
separately we can share.
Yeah, we will share. So it's basically from March, because that's where the year we have taken, and then
March or June, whatever you want to tell. Please say how much we have write-off and how much we have received. 2 figure I want. How much we write-off and how much we received.
So write-off is there around 1,500 crores, and the balance will be a part of either runoff or the sell-down.
What is the meaning of runoff?
Accelerated repayment.
Yes.
Okay. And this now balance payment is 3,416, right? And you are telling one is 80% is in one group only, right? Real estate large developer.
No.
No. The book is now 3,400, we have NPA of about 850 crores. Out of 850 crores, there are two NPA accounts. Out of two, one account constitutes to 92% of the NPA.
Okay. 92% of NPA. And we are hoping it will settle in this current financial year, or maybe next year.
I think we have been pretty aggressive on resolution, so we are pretty positive that this should get resolved in next few quarters.
Okay. Sir, secondly, after right issue, PNB holding comes at the second number after Carlyle. Carlyle is having 32.7, PNB 28.2. So what will happen now? Is PNB lose as a promoter soon, or will you change the name PNB Housing?
So I think I would not be able to answer that. As of now, PNB is a promoter and they intend to continue as promoter. So,
as per Companies Act, now PNB has no promoter at all because Carlyle has more stake than PNB. If Carlyle has given you the proposal in the next board meeting, please change the name. You have to change it. So
no, sir, it is not. No, sir, it is not like that. Even under the regulation, it is not like that. PNB will continue to be the promoter. They have also, if you can see that there is a press release they have issued, that they will continue to be the promoter. They currently hold 28.2% stake in the company, and even our trademark agreement is very clear on that front that we continue to use the brand name of PNB.
Because as a PNB, the company is in total mess. Till you remove the name of PNB, it can't be bright future. So my opinion, how you change the name, it will be more better for investor and you. Okay, thank you very much.
Thank you. The next question is from the line of Onkar Gurgade from Shree Investments. Please go ahead.
Disconnected. Harry.
Yeah, in the investor presentation which you have uploaded, you have mentioned, and in the conference call just now you mentioned that you are targeting around 17 to 18% of loan book and disbursement of 20-21%. So for this quarter, it is, a huge difference. It's around 5-6% growth and 3-4% growth. How will you manage that for the whole year? If you are targeting 17, 18, and 20-21% kind of growth.
Yeah, correct. So if you see, quarter one is always cyclical. So I think this is true for the industry. For all the HFCs, we can see this trend. So for us, there are 2-3 reasons. One, of course, it is cyclical, and number two, quarter one of this year, quarter one of last year is not comparable. Now, having said that, if you look at our last couple of quarter performance on either book growth on the retail side or disbursement growth, we will pretty good on that. So our 17 to 18% book growth and disbursement growth of 21% is intact, and we will be able to achieve that.
So, but in order to compensate this low growth of this current quarter, you will have to do significantly better for the rest of the year, right? 9 months. So, is it possible to do that?
Very much possible.
Okay. All right.
I just want to touch upon the earlier point. I think if this is done. See, PNB is a promoter, and they very clearly confirmed that their holding is now 28.2. They are a promoter, and the name continues. And PNB, as a parent and as a promoter, they have been really supportive to us. At the same time, we also have a few large investors like Carlyle, Ares SSG, and GA. So they're all supportive, and nothing changes just because the shareholding has changed.
Okay. The second question is on the fact that you mentioned that, if I heard that correctly, the gearing is currently 3.82, and in order, it will take around 4 to 5 years to reach gearing at 5 level. Is that correct?
Yes, 3 to 4 years is what we are expecting. We should reach somewhere around 5 plus. And again, depending on the growth and the overall target that we have 1 lakh crore, it might be faster also. But this is what seems likely scenario right now.
Okay, so in 3 to 4 years, 5 plus gearing, and what kind of ROA we can achieve?
Should be mid-teens. That's what we are looking at.
ROE or ROE?
ROE.
ROA I am talking about.
ROA, see, we have...
So we are now at 2.07. I think with every quarter and the mix changing, obviously, there will be our focus is on profitability, given the growth what we have guided. So definitely, I think it should improve. We'll not be able to give you a number at this point in time, but definitely it will improve.
Okay, so ROE you are targeting mid-teens, right, in next 3 to 4 years, correct?
Yeah, 3 years.
Okay, next 3 years. And assuming that you are saying that 1 lakh crore book, that is also for next 3 years from current 60,000?
Yeah, 3.5 years, right.
3.5 years. From 60,000 to 1 lakh crore, right? Okay, thank you very much.
Thank you.
And just a point on the other one, see, if you look at, few quarters back, our overall book growth was negative and retail also was flat. So last year we closed the retail growth at about 10% and overall book at 2%. And quarter one is got to do with the cyclical nature of the industry. So in next 3 quarters we'll be able to correct, and this we have seen at least for many, many years, at least for a little over 2 decades in this industry.
Thank you. The next question is from the line of Prateek Chheda from Guardian Capital Partners. Please go ahead.
Yeah, thanks for taking my question. So my question is more on the strategic part. When we say that we want to sort of grow aggressively in affordable housing, so what is the strategy here? Because this is anyway a very crowded space, and there are players who have created their niche. Somebody in the maybe 20-kilometer radius of the city, somebody in the 50-kilometer radius of the city. So what is our strategy? Where are we placed? What are the ticket sizes we will be targeting? And how much sort of infrastructure in terms of physical branches or employees are we likely to put in place in the coming 12 months or so?
So basically, sir, affordable, let me take 1 minute to explain about the market segmentation. There are basically 4 segments: super prime, prime, affordable income, affordable, assessment based. So as of now, our focus is on prime and affordable income based. So we are not into affordable assessment. So it's hardly anything. So we don't cater to super prime and we don't cater to affordable informal segment. We focus on the second and third bucket. Our prime business will focus on second segment, that which is called prime, and our affordable will cater to affordable income based. Now, today, if you look at any organization, be it a bank, whether it is private or PSU, very HFC, large, mid-size or small, or even NBFC, all of them, they focus on at least 2 or 3 buckets. So, if you look at HFCs, some of the mid-size HFCs and small HFCs, they focus on prime segment and affordable income segment. So, this space is not really crowded. What is really crowded is the affordable informal segment, which is a high-risk business. So, when we say that we want to grow affordable business aggressively, so my definition of aggressively, overall, both prime and affordable put together is about 17-18% book. If we talk about affordable, because the base is very small, we might grow at maybe another 7 to 8% more than the overall growth. So when we say aggressively, that is the definition of aggressiveness. It's not 40-50%. Definitely we will not get there. For the simple reason, our focus is on asset quality, whether it is prime business or affordable business. Now there is a very clear segmentation, A in terms of customers, B in terms of geography, C in terms of type of properties, 4 in terms of what is the ticket size we focus. In affordable, our ticket size will be about 16 to 17 lakhs. On the prime side, it will be 10 to 12 lakhs more than affordable ticket size. In terms of customer segmentation, top-notch customers, which is Cat A customers, and to a certain extent Cat B customers would form part of the prime and super prime. For affordable, it's going to be Cat C, both on salaried and self-employed. If you talk about salary, somebody who's earning, let's say, a salary of between, let's say, 35 to 50,000, 55,000 salary, who can afford to take a loan of about, let's say, 17 lakhs, 18 lakhs, that is an affordable segment. On the self-employed side, somebody, who's earning the income of, let's say, between 3 to 4.5 lakhs per annum, that is our segment. In terms of geography, a prime business would be not at the city center, slightly away. When it comes to affordable, it will be in the outskirts. It will be in the periphery of the given town or cities. There is a very clear segmentation of prime and affordable. In terms of branch, we have dedicated branches for prime and dedicated set of branches for affordable. The customer segment is different. The channel, set of channel partners are different. The entire team is different. Whether it is sales team, credit team, collection team, the entire team is different.
Sure. This explanation really helps. Secondly, so whenever we talk about we look at affordable housing players in a similar risk profile, they tend to operate with a very low, materially lower leverage than what you are guiding for of 5.5 or 6 times. So, if you also sort of take that route, are you saying that your leverage for the prime business will be slightly higher than that?
So, as I told you, basically when we talk about affordable, there are 2 segments within affordable. One is income and one is informal. So, largely our focus is going to be on affordable income based. So, what you're saying is true, for a set of companies, which focuses largely on affordable informal. Now, if you have to look at the asset quality difference between, let us say, prime and affordable, it's about 10 to 15 bits. So, yeah, to answer your question, leverage obviously on the affordable will be slightly lower compared to leverage on the prime. But for us, today we have a book of about 60,000 crores. Out of that, retail is about 55,000 crores, right? So, it's about 57,000. So, what I'm saying is that it will take some time for us to build the affordable book because we just started affordable, right? It will take some time. Incrementally, we'll be able to reach about, this year it will be about 10 to 11%, and in next 2 years we might reach to about 20-25%. But at a book level, this is incrementally. At a book level, it will take time to catch up. So I think given the mix of prime and affordable, I'm saying around 6 to 6.5 leverage is pretty comfortable.
Fair enough. Thank you very much. Lastly, on the corporate side, what would be a security cover for the 92% GNPA account that you talked about? How much would that be? And is there any real account which is there in the stage 2 right now which can, sort of likely to slip in the next, 2-3 quarters? Or should we expect that this is the asset quality has bottomed out in the corporate segment? Or is there anything additional that can come out in the next quarters?
So normally we don't talk about any individual accounts, but I think just to answer your question, our coverage is more than 2 times. A. B, I think corporate is more or less sorted, and we have we're doing a lot of work on resolution and to run down the book as soon as possible. At the same time, we would also have certain write backs in next few quarters.
Perfect. Thank you very much.
Thank you. The next question is from the line of Kushan Parikh from Morgan Stanley. Please go ahead.
Thank you for taking my questions. I had primarily 2 questions. The first question is around the write-backs actually that you mentioned just now in the previous question. So we have taken write-offs to the tune of more than 2,000 odd crores over the last 6 quarters. This is both corporate and retail combined. So just wanted to understand what is the kind of or the quantum of write-back that we expect, and over what period of time do we expect that write-back to come back to us?
See, these are corporate accounts. So the nature of accounts are such that, I think nobody would be in a position to predict. But having said that, in next few quarters, definitely we are expecting some write-back.
So it would be helpful if you could share some sort of estimate that we would have for this.
at this point in time, it will be difficult. Maybe in future, if we are very sure of that, we will. But we are doing a lot of work on regulation, and we are using multiple tools. And, so in certain accounts, we are working, where a new developer would come in. In certain accounts, we are, we have fast-tracked our legal. So multiple tools are being used to try and resolve this account. Given the nature, it will be very difficult to give a definitive timeline. But definitely, yes, we are really pretty aggressive on the resolution, especially on the corporate side. And in next few quarters, definitely it will be aggressive. It will be difficult to quantify. How many accounts, what amount, it will be difficult to quantify because, the amounts are large. These are corporate accounts. But definitely, yes, they will be like that.
Understood. And just also on the retail written off accounts, I mean, any guidance on that in terms of write back?
There is no guidance on it, but it happens every month. So I think that's part of our GNPA plan and also our profitability plan. So we've said that in next 4 to 5 quarters, our GNPA at an enterprise level, at a company level, would be comparable, with one of the best in the industry.
Understood. That's
prime and affordable.
Sure. That's quite helpful, sir. And my second question was around the cost of funds. So, I mean, we're currently at a book cost of 8%, incremental cost of 8%. So what is the scope of reduction that we see in cost of funds, given that now our rights issue is completed and that should help our capital position. So just trying to understand what is the scope of reduction in cost of funds that we see over the next 12 odd months.
Yeah, so definitely I think we also see some improvement on the cost of fund side. So as I had mentioned in the earlier earnings call, so now we will have access to NFB funds, which will come at a lower cost. That is number one. And number two, we are engaging with all the banks, and few banks have already passed on the interest rate benefit to us, considering company performance improvement and also capital position strengthening. So this also we expect going forward, and we are engaging with other rating agencies, for outlook change or upgradation. So we're working parallel with all of them. So definitely we should see, a few bits. Today, if you see the difference in cost between the best managed in terms of cost and us, it's about 50 bits, right? I think we'll be able to easily cover 50 to 60% of that we should be able to cover in next few quarters.
Okay, so you're saying this 50 bits odd gap, we should be able to cover 50 to 60% in the next few quarters?
Yes.
Understood. Just one last clarification related question, if I can squeeze it in.
Sure.
Thank you. So just on the loan growth guidance, the 17 to 18% loan growth that we are speaking of, is that on the retail loan asset?
Yes, that's on the retail.
And that would be that would involve about 25% disbursement growth. Is that the right understanding?
Yeah, 22% plus is
disbursement will be 22%.
Okay, understood. That's really helpful. Thank you. That's all from my side.
Thank you. The next question is from the line of Manish Maheshwari from Manu Group Family Office. Please go ahead.
Sir, what is the total deposit base as on 30th June?
It's around 17,000 crores.
Sorry?
It's around 17,000 crores.
I'm sorry, I can't hear you. Come again?
17,000 crores.
Okay. 17,000 crores.
Yeah, around 30% of our total borrowing.
30% of total?
Borrowing.
So what is the guidance on credit cost for whole of FY24?
60 basis points.
60 basis points?
Yes.
And gross NPA and net NPA?
There's no guidance on GNPA and net NPA. So as I've told, in next 4 to 5 quarters, we would be quite comparable in the industry.
So we are going very aggressive on affordable housing per se. So if you look at affordable housing demand has been shrinking, right, in the recent past.
Sir, we started affordable business just few months back. So in the first part of the quarter when we started, we did about 137 crores. And in quarter 1, we did 228 crores. The base is very small. And this year, we said the mix is going to be about 10 to 11%.
Mix of the total
disbursement. Between prime and affordable.
10 to 11%.
Yeah. So which is not at all good.
Sorry?
Current year disbursement mix between prime and affordable is going to be about, let's say, 90-10 or 89-11.
And you have kept your NIM guidance also a little low, right? I mean, the NIMs that we have, NIMs for the current quarter is 3.85, right?
Sir, normally when we give guidance, keeping in mind the long term on a steady state. So there could be fluctuations in the short term, but on a long term basis, on a steady state, this is the guidance.
And loan growth, I mean, one of the previous participants was perhaps alluded to this particular thing. Loan growth guidance you have given for 17 to 18% on the retail side.
Yes, right.
And which would percolate down to what sort of disbursement for FY24?
Sir, I think every company would have their own math. So as far as we are concerned, sir, disbursement growth will be about 22% and book growth about 17 to 18%. Because it is a combination of what mix we are going to have and what is the runoff. There are so many things which gets into this, but as an outcome, we would be able to deliver 17 to 18% of book growth and 22% of disbursement growth. Given the industry growth rate, this is for us. I've said this before, again I'll be saying this, for us asset quality is the starting point. We are back to basics now. We are talking about increasing our salaried within the profile, increasing home within products, between home and non-home. And we want to reach to an ideal mix of between prime and affordable. And disbursement of growth of 17-18%. If you look at the industry so far last few years they've been growing at about 13-14%, and we are talking about 17-18%. And asset quality is the starting point. Our asset quality in next 4 to 5 quarters will be comparable. So the growth rate of 17-18%, given strong demand in the sector for next few years, 17-18% for us it is possible.
Thank you. Manish, may we request you to join the queue for any follow-ups, as we have several participants waiting for their turn. Also, participants, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to 2 per participant. If time permits, you may join the queue for any follow-up. The next question is from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. So, sir, look at the top 5 states share in the retail loan.
Is not very clear. Yeah. Please use the handset.
Sure. Is it better now?
Yeah, better now.
Okay. Sorry for that. So, if I look at the retail top 5 state share, then and if I try to get the composition of 2.49% of retail GNPA, then are they in line with your top 5 states spread?
Sorry, didn't get your answer.
So the top 5 state share in retail loan assets, which is topped by Maharashtra, Delhi and Tamil Nadu, is your retail GNPA geography-wise breakup also on similar lines?
It's almost similar.
Okay. Thanks for that. So secondly, you have been reiterating the fact that there is incremental focus on salaried segment. But if I look at 1 year mix between self-employed versus salaried, then that has not sort of changed materially. So what is the target mix here and the timelines for the same?
So here there are a few things. See, when we talk about the portfolio, what we are going to build. So we are talking about few things. One is the customer segment. Second is the profile. Third is the collateral. And fourth is the ticket size. So as I had mentioned in the past, we are now back to basics. So if you always look at portfolio obviously will take some time to correct. If you look at incrementally, I think we are in the right direction. So that's our focus. So our pricing strategy, our geography strategy, everything is aligned to our goal, which is basically to change the profile mix, product mix, focus on low ticket. I spoke about focusing on up to 1 CR. I spoke about, especially within LAP, there are some of those high value cases which we had in our portfolio in the past, which we are doing in the past. So now we have come out of that. So if this is a journey, it takes time. While we have a portfolio to deal with it, we are dealing with it. The portfolio, what we are going to build, I think this is the direction in which we want to go. I mentioned about we would ideally want to get to salaried and self-employed of 65 and 35. It will take time. So we are on the right track and it will take time for us to get there.
Sure, that's helpful, sir. Thank you.
Thank you. The next question is from the line of Franklin Moraes from Equentis Wealth Advisory. Please go ahead.
Yes, sir, congratulations on a good set of numbers and having been able to achieve multiple milestones in this quarter. So my question is on the recoveries. You alluded to the fact that there could be certain recoveries that we can expect in the coming quarters. So does your credit cost factor in these recoveries?
See, I want to say the same thing. So last year, if you see, our credit cost was 1.15, and this year we said it is 0.6. If you look at quarter one, it is 0.36, right? And this 0.36, significant portion of that is towards building up PCR, right? So on the corporate side, the write-backs are not factored into this.
Got it. And secondly, you also mentioned in your opening remarks that you have increased the share of South. And now, traditionally, we have been a player who have operated in the North and, in the West. So is this going to be directional, or is this just a one-off?
No, it's like this. So we are a national player, and we want to present in most of the states which are good for us from A, business point of view, B, repayment culture point of view. So we have done little tweaks. That's all. Otherwise, if you look at between South, North, and West, largely these three zones, I think all the three would be 30+%. So I think it's going to be almost equal. And we are not largely present in East. So I think the tweaks are going to be very, very marginal. But yes, even at a portfolio level, 1 or 2% would mean a lot to do good for the portfolio.
Yeah. So thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference back to the management for their closing comments. Thank you, and over to you.
Thank you, everyone, for joining us on the call. If you have any questions unanswered, feel free to get in touch with the Investor Relations team. The transcript of this call will be uploaded on our website as well as the audio. Thank you.
Thank you very much. Ladies and gentlemen,